Hello again, everyone. John Flynn here from Flynn Real Estate in the Southern Ontario housing market. Thanks for joining in again. My purpose here is to bring you my informed opinion and honest opinion about the Canadian housing market, and I deal with both local and the national market. So today, I'm going to hit you guys with a lot of numbers, not too many, but a lot of numbers, and I want to talk about the rising mortgage rates that we've seen in the last week. First of all, here's some interesting stats to start off. So in Canada, home prices are approximately 20 to 30% above the capacity of median household incomes. I don't know if that's self-explanatory, but home prices are 20 to 30% above what people can afford or what their household incomes should be able to afford. Next, the average 5-year fixed mortgage rate is expected to rise to 4.25% by the end of 2022 and around 5% in a few years. Here's also a list of the average house prices for February 2022 by province, starting with the most expensive province, BC, and working our way down. So just for interest, in case you're thinking of moving, I have many clients that move to different provinces. The one that actually got me the most was the Northwest Territories or the Yukon Territories. And I don't know if it's the cost of building up there, or if it's, but anyway, it's pretty expensive up there. So back to the mortgage rates, or the bank interest mortgage rates for homes. They jumped, depending on the bank, 3 to 4 times within about a week last week. So that was some big movement. And there's two ways to look at it. First way, interest rates are going up and the prices will come down. That's the way I usually look at it. And if you've watched any of my recent videos, that's what I say. Interest rates go up, prices come down. There's also another way to look at it. Interest rates are going up. Homes will become less affordable than they already are, due to the increased interest payments and mortgage payments, right? So there's two different ways to look at it. Could be a combination of both of them. I think interest rates go up or mortgage rates go up, prices come down. But anyway, there's two different scenarios. So here's the most recent rates from the big Canadian banks, the big five. I know some people say there's 6, 5, 6, whatever you call it. There's 5 of them. This is from ratehub.ca, so a pretty reputable site. And you can see the variables. Now the variables were about 1.25 to 1.5 with the big banks a month or so ago, and they're at 2 to 2.2 now. So variables are up, and also the 5-year fixed. Now a month ago, again, you can check back on my old videos, but you don't have to do that. They were, from the big banks here, like 2.89, and then they went to 3.19. But they're up between 3.5 and 3.7% is what you're going to pay with one of the major banks in Canada for a 5-year fixed term. And now we get into the States. So the States, their 30-year fixed is their big product over there. And they're up to 4.6, 4.5 usually, I think, is the national average. But this is the Bank of America here. And their variable rates 3.6 or 3.5, depending on where you go. So they're like approaching 5% in the States, and that's why their prices, again, as I've said before, why their prices haven't accelerated like ours have, because we're still a lot higher even in Canadian dollars compared to US. So, of course, interest rates go up, houses become more unaffordable. So we're going to look at 3 scenarios that I put together for Canadian mortgages, and these are like realistic scenarios that I come across or that you may know people. So the first scenario, you have the average new mortgage of approximately $370,000, and this is according to CMHC. It was Q4 in 2021 was $358 for the average new Canadian mortgage, I should say. This doesn't mean first-time home buyers. This is just a new mortgage. It could be someone that has sold, they have equity. It seems pretty low, right? $358,000, but this is the stats from CMHC, and not everybody is buying an $800,000 house and putting 10% down and has a big mortgage. So the average new mortgage in Canada, and I'm going to round it up to $370 for right now because of course prices jumped. So First scenario, you have a mortgage of approximately $370,000 and you have a variable rate mortgage. Approximately 50% of people in Canada, new mortgages now are variable rate. A mortgage of $370,000 at a variable rate of 1.25%. You shopped around a month or two ago, let's say, and you have this rate. And it's a 25-year amortization. You're paying $14.36 a month, right? This doesn't include property tax or anything like this. This is just a simple mortgage calculation. Then let's say now your variable, that bank you're with, it's at 2.2. A couple months later, you're up to 1604. So you went from 1604, or you went from 1436 to 1604, $180 or $170 a month extra. Now you're getting worried. You're saying, look, this is going up. The interest rates are going up in April most likely. The banks might put them up. You're listening to this video. It's going to be 4.25% for fixed. Variable is going to go up. You're getting worried. And I've been in this situation. When I bought my first house, I was a variable rate and I saw them go up. It didn't take much, and I said, I'm locking in. So then you lock in, and this is at today's rates. Usually you're not going to get the best rate, but let's say you get a good rate and you lock in at a 3.6 on a fixed rate going forward now, because you're worried about these rates going up. Now you're up to 1866. So you went from 1436 to 1866 a month. That's $320 or $330 a month, just because the rates moved a bit and you got worried. And this is not unheard of. This happens all the time. At least now you know for the next 5 years you're going to have a fixed rate mortgage, and you don't have to worry about it rising. It's probably not going to go down, so that's a good option. It's a very smart thing to do. Scenario 2, you're a good citizen, you're a first-time buyer, maybe you're a new immigrant, and you bought the average house in Canada, which was $816,000. You have no equity, so you're not transferring your equity and getting a $370,000 mortgage like the first people. And you're a good worker, good citizen. You saved up $163,000 or whatever the down payment was, and 20%, right? You don't want to pay CMHC premiums. You saved up and you got the mortgage with 20% down. So your mortgage so 860. Now, actually, let me go back. The HPI is actually higher than that. The home price index for the average of Canada, it's like 860 or even higher at this point in time. But we're going to go with the average house, 816. So good citizen, 816,000, 20% down, save lots of money, paid your closing costs on top of that. So your mortgage is 653,000, and you had that rate a month or so ago of 1.25%, a great variable rate mortgage. And your payment's just over $2,500 a month. And it's a variable rate 5-year. Now, a month later, you're paying, without doing anything, you're paying $2,800 a month. So you're paying an extra $300 within the span of a month to 45 days because it's going up. Next month, your payment comes in and it's an extra $300. Again, same thing. You're like, I don't know about this. I think I'm going to lock in because who knows how high these rates are going to go. And common thing to do. So you lock it in, and your new payment's just under $3,300 or $3,300, and you lock in at 3.6, even 3.5, whatever. It's still going to be close to $3,300. So you went from, in the matter of a month or two, it could be 3 months, you went from $2,500 to just under $3,300. So you're paying $800 more a month, and this is happening now. And it will be happening more once people start to realize and see their next monthly payment come in on their mortgage, and it's a lot higher. All right, now we have scenario 3. First-time buyer, you bought a house for less than the average house price in your area or in Canada. You spent $650,000 with 10% down, and here you have your mortgage payment. You got the 3.19% because you had your pre-approval before now, so you got a decent rate, and you're paying just approximately $2,900 a month. Your mortgage would be $603 because you do have some CMHC mortgage insurance premiums to pay. So you're paying $2,900 a month, and you're good to go. Let's say in a couple years from now, the house prices have gone down, and they've gone down 24%. There's an article going around from Oxford Economics. You can look up who they are. Here's a screenshot, and this is from the Financial Post, but this article can be found many places. And they're calling for a 24% correction within 2 years. And you can read the article. I'll link it in the description. And the article is actually pretty informative, and they back it up with the reasons, and they're legitimate reasons. And I wouldn't doubt it. That's a minimum. It could go more, they said, but realistically, let's use that number for this scenario. So 2 years down the road, you're a first-time buyer. You have your house that you paid $650,000 for with your 10% down, and you still owe $580 or $590, and the house is worth, when you lost your 24%, you're at $525,000. And again, with that drop in price, these prices are still 15 to 20% above the pre-pandemic levels. So it's not like this is a 1 year loss, right, that we've had. Like, so whatever it was last year, it's dropped back to the same level from a year ago. So this is not an unrealistic scenario. So now your house is worth, a couple of years from now, your house is worth $525. You're paying $2,900 a month with your 3.19, and you know your renewal is coming up in another 2 to 3 years, and it's going to cost you an extra $500 to $600 a month once that renewal comes up, and your house is $525,000, and you owe $580 or $590. What do you think a lot of these buyers are going to do? You think they're going to keep paying for it, knowing that it's going to sink them in another few years? Are they going to reset? And this is what happens. And it doesn't take that much in mortgage rates for it to happen. Anyway, back to the first question. Do you think with a rise in interest rates, home prices are going to come down? Or do you think they're just going to get even more unaffordable or more pricey for the average consumer? I'm with prices come down, because we've seen it in the past, we've seen it in history. They're going to come down. Yeah, at the end of the day, it depends on who are the main players in the market and what do they do. And to me, the main players, well, government rules and government policies are the number one factor when it comes to whether it's interest rates or stress tests or whatever they do. They persuade the market, but it's the investors. People that, when you have a house and you live in it, your odds of walking away from that house are a lot less than an investor. An investor, now they've been in the game maybe longer than a lot of these buyers have recently, and they're going to have equity. And when they see it go down 10%, 20% after 2 years, they're going to be selling that thing, and they'll be flooding the market. And that's when we're going to see supply pick back up. And once that balance comes back, and we already see signs that it is happening with just these rates alone. I've seen some shifts in the market already. It's still too early for me to say, like, with concrete evidence that this is what's happening. But as time goes on, we'll see it. So they're going to get out of the market, and there's going to be a lot more listings, and you're not going to have to worry about building these new homes to meet the supply, because the supply is going to shift. It's going to shift from an of demand of properties to an oversupply, and the investors are going to accelerate that because they're not in it to lose money. They're in it to make money, and depending on their position on when they bought this house, they're gonna dump it. So anyway, that's my take on these interest rate rises. It's happening. It's all to do with the bond yields and all the rest of that, but the banks have to cover their expenses, and this is why they have to put them up. Again, like, subscribe. I'm going to keep you updated with my honest opinions on what's going on in the market. And hopefully it's not all doom and gloom, but we're overdue for something, and I think that this could be the start of it now. Next week, actually, I'm going to have the March stats, so we'll really take a good look at if we see any early numbers and anything that's happening. I think we will, because I've took a little peek myself, but I think we will see some early evidence of what's happening. Anyway, thanks again, and I hope you enjoyed the video.